This is Peter Hans, and welcome to Between Two Chains. Feels great to be back after a few months hiatus. And this week we have an amazing guest. This is an episode that I really enjoyed recording, and I hope everyone enjoys listening to as well. The guest is none other than Raoul Pal from Real Vision and Global Macro Investor, someone I've known for many years before our days in the digital assets ecosystem. And we talk about a lot: inflation, the future of the market, Bitcoin, Twitter, making parallels between today's digital asset universe and things that we've seen in our prior lives in more TradFi and traditional hedge funds. It's a great episode. I hope everyone really enjoys it. Please subscribe, rate, and review the episode. And I'm very excited to be back and sharing Between Two Chains with everyone here. The commentary here, well, we got to do the disclosures first. So the commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. Okay. All right. Hello, and welcome back after a little bit of a hiatus to Between Two Chains. I'm excited here to have Raoul Pal of Global Macro Investor and Real Vision on the I don't know if you would call it the second inaugural episode of Between Two Chains or something, the relaunch. But couldn't think of a better person to have on. You're my first choice, and thankfully you agreed. So
Always, my
great to have
friend.
you.
I'm looking forward to this.
Yeah, me too. Me too. So it's been a little bit of a different market too in the break. So hopefully the relaunch of Between Two Chains there is a true positive correlation between market
When did
performance.
it stop last time? This is important to know. Maybe you are the signal.
March.
Yeah, there we go.
There
Stop in
was
March.
there was a little
Market
rebound.
collapses. We relaunch. The market can go back up now. It's fine.
I think
Done.
there's a lot of validity to that. Yeah, correlation, causality, it's all the same.
Yeah. Who cares?
So, given that, I'm curious kind of where you think we are, and this could be, digital assets specific, though frankly everything is fairly correlated from a risk asset perspective now. So I would love to know where you think we are right now.
So I've got as clear a view as I could possibly have. Nothing is a certainty, but for me, the macro is rolling over. By that, I mean we're going into recession. We should see the things like the ISM survey and other things start falling apart pretty quickly. The forward-looking elements are falling apart already. We're seeing it globally. So that's growth evaporating. Alongside that, the narrative hasn't caught up. Most commodities are down between 30 and 50%. Oil is the last to crack, and I've been talking about this on Twitter and been writing about it for a period of time, is everyone's long and expecting oil to go to $200. I think there's a washout coming and it goes down to 60. So that's the last inflation story. Everything else from the raw goods then comes into the supply chain and then eventually starts fading. So we're going to see that inventories, because people build massive inventories after COVID. Those inventories are now unsold because of the economy slowing down and inflation eating disposable income. So we've seen it from Walmart, Amazon, and others. They're going to start discounting inventories to try and shift it. People are laying off staff. So the macro cycle is going to get to the ugly phase. Okay, why is that making Raoul bullish? Well, because the outcome to that is as inflation comes down and bond yields fall, liquidity conditions improve. And what drives financial markets at the macro level the most is liquidity conditions. We've just gone through the largest tightening in financial market history because the rate of change of interest rates going up was the fastest ever. Mortgages are back to where they were in 1996, and it's shocking. Then the dollar went up at a rapid clip, which is a tightening of financial conditions, and then commodity prices went up. So basically, everybody's suddenly skint, as an Englishman would say. Nobody's got any money, and the economy implodes. So the forward-looking indicators suggest to me that this goes off a cliff fast until we probably bottom Fed March next year. That's the economy. now. Forward-looking assets' job is to look forward. So one of the reasons crypto, digital assets went down was because discretionary spending came out of the market. So if you think of the legions of dollar cost average retail investors and just think of their rent or mortgage payments went up, their shopping bills went up. So suddenly, or if they were foreigners, the dollar went up. So suddenly, how the hell can they buy as much dollar cost average in crypto? They don't. They don't. So they stop. So what happens is you've removed a huge amount of buying power. So as these conditions change, that changes. Also, the other big players in the space now, the hedge funds, the crypto, the macro funds, and then the institutions, well, they're also a function of liquidity. So when liquidity is more available and cheaper for them, they can apply more leverage essentially in their portfolios. So what we end up with was a position where the big thing that correlates to crypto markets overall is some definition of liquidity, and you can use M2, global M2 year on year. That looks pretty much like Bitcoin year on year or crypto market cap year on year. We're at the very bottom. It usually turns around at this point because eventually the outcome is central banks have to provide liquidity in a recession because there's no liquidity. So forward-looking assets like crypto are picking it up. So they also have perfectly correlated to the turning point in the inflation cycle. So they kind of time the bottom, and I think it's time the top. So basically, I think crypto is saying, okay, inflation has now peaked, and therefore the marginal pressure from tight liquidity is gone. So my view is let's give it a probability, 70% probability. So that's pretty high conviction that the low is in. And therefore we're starting the upside cycle. So the macro, I think for me, even though everyone thinks, oh my God, it's terrible, the equities are going to sell off. Well, the equity side of the equation, that correlation with equities was actually a correlation to liquidity. They're all actually correlated to the macro cycle. Can equities sell off further? Yes. Can crypto decouple? Yes. We saw that in March 2020, that crypto started going up when equities were going down because crypto is more forward looking. However, equities have actually priced in quite a lot already. So it's not 100% clear whether equities need to go down or not. So I did a Twitter poll recently with like 20,000 people responded, which was, do you think equity markets have further to fall? 70% of people thought so. And I said, are you underweight where you typically would be or in line? And 70% of people are underweight. Well, if 70% of people think the market's going to fall and 70% are underweight anyway, who's left to sell?
Sure. Yep.
So that's, and it was the same with crypto.
Yeah. I mean, every market at the end of the day is a story of marginal buyers and marginal sellers, right?
Exactly.
And historically, it's always very difficult in the moment, but historically, these are, peak fear correlates very well retroactively and with good buying opportunities long term. There's so many directions I could go off of everything you just said, and it made me think of a lot of different questions. One of them is, just in terms of going back to the macro, in terms of the inflation story, definitely you saw like the news out of Walmart, out of Target, in terms of inventories and forward-looking sales, and stocks all got crushed on Target's announcements, on Walmart's announcement, let alone what previously happened with big tech and multiple compression. But inflation to me is interesting because of the COVID dynamic, and I think there is a lot of validity to supply chain issues as someone who's been building a house for the past 18 months and buying new cars and things for my wife and things like that, and there's still nothing on lots, and GM is sitting there with massive amounts of unfinished inventory because they can't get semiconductors, and you look at prices of from eggs, milk, bread, sandwiches, like normal food type thing. So how much of do you think we can almost see a decoupling in inflation where discretionary spending, retail goods, things like that, drop potentially precipitously, but you still have supply chain issues and other things that keep supply tighter and still an inflationary environment in autos, food, computers, anything else there.
Okay, I'm going to say something contentious. I think inflation is negative in 18 months.
Okay, just
I
everything.
do not think, I don't think prices fully come back down. They never do.
Hmm.
They never
Of
mean
course.
revert. But I think we will see an unwinding. What you're seeing is what happened 18 months ago. This is how things work. It has to go through the supply chain. So the issue of you not being able to get stuff, and I've got the same issue, can't get
Mhm.
stuff, that's 18 months ago problem. The actual problem being faced is who the hell are GM going to sell those cars to,
That's fair. That's the other
right?
side of
And
it,
at
right?
what
Yeah.
price, right?
Mhm.
So what we're doing here is we are seeing the tail end of what happened 18 months ago. I think that's going to be dramatically reversed because the supply chain issues are really not as bad. Now, there are issues within commodity markets like oil where we haven't had enough spend. But I don't see a massive increase in demand for oil. Chinese economy is slow. We've got aging populations everywhere. The demand for oil is the 5 year on 5 year rate of change of oil demand is negative.
Mhm.
I don't see the demand story. I see a supply story, and there's a lot of people looking at commodity markets going, yeah, oil's going to $200. Yeah, if you can get demand back to where it was, we're assuming it is. And people are extrapolating demand post COVID, which was a stop of demand, re release of demand coming back on. That demand goes back down to trend. So I don't see it. So I'm guessing that as oil comes down to $60 or so, as everybody gets washed out now, most commodities are down 50%, so that would be about right from $120 to $60. How fast does it recover? Well, maybe it recovers reasonably quick because the supply issues, and after a recession, there's a recovery. Are we going to go screaming through $120 and have rates of change that lead to inflation? I just don't see it. Now, the other argument people have is reshoring. Well, reshoring is going to create inflation because we need to build all these factories. If anybody's looked at what Elon Musk has just built, and I published this in Global Macro Investor, the video of the drone going through the Gigafactory, there is a
Mhm.
gigantic, massive factory. Not a, well, in the video, there's not a single person. It's all robots. Right? This is not wage inflation. This is not, and the efficiency of building a factory now is not as commodity intensive, and it's not like we're entirely rebuilding countries. So I think at the margin, demand can be higher. The rates of change of commodity prices won't be enough to generate inflation. So to put that in perspective, the last time we actually had demand pull inflation was the 2000 to 2008, and that was China coming on, and they were building empty cities and empty roads and empty bridges and empty
Sure.
railroads and everything. And commodity prices went up. They went up 2x. The rate of inflation, 2.7%.
Mhm.
It just didn't. You have to have a really, really shocking outcome to create inflation that's sticky. So I know the narrative is incredibly strong, and I sound like a lunatic by saying, well, it's not going to be like that. I strongly believe with an aging population, massive debts, and a recession dead ahead, the ability to generate persistent inflation going forwards until the end of the next business cycle. There's always inflation at the end of a cycle. The end of the next business cycle, sure, inflation will be high again. The Fed will be raising rates again, or doing what maybe they won't raise rates ever again this time. But then eventually you go to recession, prices fall. That's how it goes.
Yeah. No, I mean, there's certainly hints at that in the forward bond curve, right?
Well, the bond
So
market's it's pretty
yeah.
clear. It's like I don't know what you worry about, guys. You just it's usually equity and commodity guys saying trying to be macro guys,
Mhm.
and the bond market's like no. This is our job here. Our job is to say there is no inflation coming, so just get on with it.
No, and I mean, yeah, I mean, I know what I think to this, question. But do you? so I mean, it sounds like your opinion is very similar. Is there a is there any chance, maybe that's the wrong word, that we ever see an environment with, quote unquote normalized Fed funds rate, normalized interest rates, or we, we
What
might have these like brief
normalized
cycles of.
normalized for what? This is an argument that again I just don't even understand what people talk about. What their normalization is the glory days of their youth when they got their first mortgage and interest rates were 6.5%. Right?
Sure.
It's just a recency bias. If you go back and look at the history of interest rates in the United States, the average has been 2%.
Is that
Right?
right?
It's just nonsense what people talk about because they think about the 70s. And so most people in financial markets who are bickering about this are either boomers or Gen Xers. And Gen Xers, we all bought our first houses in the early 90s when interest rates were at 6%. So that's normalization to us.
Mhm.
What we need to normalize for is population age, amount of debt. Right. So I look at the real 5-year real rates, which is the 5-year break even rate
Mhm.
minus the 5-year bond rate. That has been trending down for 20 years and has been negative for the last 10. If I just do a log regression channel on Bloomberg, it's at the top of the channel. It's gone positive recently, right? It got to 50 basis points positive, and we broke the economy. 50 basis points positive real rates. And it says the trend rate of real rates, ignoring what the economists say, what should be theoretically modeled, the trend rate of real rates is negative 1%. And it goes down every single year because of debt and demographics. So if I think normalizing rates, I think real rates need to go back to negative 1%. That's what I think of normalizing rates. So negative 1% with call it a structural 1.5% inflation, its bond yields at 0.5%. That seems about right. And that's exactly what we've seen in Europe, exactly what we've seen in most of Asia, Taiwan, South Korea, all of those countries. It's exactly what we're seeing in Switzerland and what we've seen in Japan.
Yeah. No, yeah, different rationale for me, and maybe it's more, I don't know, simplistic. I mean, I think about the housing market, right? Like the majority of savings in the United States is your primary home, and it is politically unsustainable for interest rates to ever go higher, for home prices to fall. It is the one thing that is completely political, like a political non-starter, right? The most powerful lobby in DC is the the real estate brokers, because they're represented in every jurisdiction. It's by far the most powerful lobby that no one ever thinks about or talks about. But there's a reason why none of these Redfin or companies ever work, right? Because they're going against the most powerful lobby in the country. And if you think about like the economics of every business has changed over time except for real estate. You're still paying 3% on both sides every time you sell and buy a house because you're going up against the most powerful lobby. And if you can decrease the velocity of home sales and home prices, because like, well, now that rates, I have a 2 5/8 jumbo that I refied to earlier in the year, and now it'd be, I don't even know, say it's 6%, 6.5%, right? Like I told my wife, like, we're never moving, because I'm not getting out of this mortgage. And then we're gonna go buy a place that's, say it's the same price, but the mortgage is 3x, right? Like your monthly affordability is completely shot. So people can't get out of their homes. It doesn't mean home prices are going to fall, because you don't have the same issues you had in '08 with negative amortization loans, and like everyone has a 70 or 60 LTV loan now. So like there's no issue. The banks would probably love to foreclose, but no one's going to foreclose. It's just no one's going to buy or sell, right? And it's just, you saw it all in China all the time too, with like what are politicians willing to accept on their watch, and the answer is like not a hell of a lot. So I just, you can get into these environments now where rates are high, for a very short period of time, but like that ain't lasting.
And also, there's another big secular trend, which is everything is getting digitized. Everything that gets
Mhm.
digitized goes to zero in cost.
Mhm.
Every single thing. And one of my hypotheses is, as we digitize electricity, essentially, by going away from fossil fuels to other sources of renewables, we will see the cost of electricity collapse. It's already been collapsing as a part of discretionary household income for a long time, which people don't realize, but it's going to go down and down and down. It's where electricity is relatively a free input. I mean, this is actually the big breakthrough of digital assets. If everything in a digital world goes to zero in value because of excess abundance, i.e., it's all supply, without blockchain, kind of you're totally screwed because it was everything disappears in value. But with blockchain, you actually cement value in a digital world, which was an impossible task beforehand.
That is interesting. Um, yeah, I mean, it also, and this is a big part of like my thesis and Arca's thesis is in essence, the blockchain allows for the to increase the velocity and productivity of those assets, right? Whether it's fractionalization, distribution, like using anything as collateral. My partner Jeff always has something like you might go into Starbucks one day and you can theoretically pay with a portion of your car or something like that. Because anything can be used as collateral and anything has a value. Maybe not that. That's not the best example because it's not exactly like a liquid for a one of one object, but there is a lot of there's a lot of interesting thought that you could have around that discussion. So, all right. So given, I think we're in agreement, right? So I saw the bottom, and I hesitant to use that word mostly because I hate Twitter, but but you know I saw it in June because to me, and I think we've seen this play over, people like us who are, you know, been around for a few decades and have seen different cycles and different asset classes, right? I always look at the bottom of the market when you see kind of the counterparties go under and the mass capitulation kind of across the ecosystem. It doesn't really have anything to do with fundamentals or or bullishness or bearishness, but it's just like when you see that massive amount of forced selling, and digital assets is very different than even traditional markets because you don't have the institutional buyers, right? Because of the regulatory kind of lack of clarity now. It's not like JP Morgan or Warren Buffett's not coming out and writing big checks. You had FTX do a little bit of that, but they're not, they're big for crypto, but nothing else. So and you don't have TARP, you don't have any Fed bailouts, or so it all had to happen organically, and that was like I thought pretty remarkable that the system was able to absorb it and only experience down 80% ETH. Like that's pretty remarkable.
Yeah, and but what it did do is the classic, and as you've alluded to, in the end, these things flush out bad leverage, and the bad leverage was the fact, and I've mentioned this many times, it's exactly the same as long-term capital. There was one person who was everybody's biggest customer, and either people went la la la, I can't hear you, or didn't do good risk management.
Mhm.
So once that customer starts getting recalled on some stuff, it daisy chains immediately on a scale that nobody could have imagined. It was exactly the same as long-term capital, same as Lehman. We've seen this over and over again. What's great about it is, as you said, it happened pretty orderly. It was pretty ugly. Some people really, firms got destroyed. But overall, it happened naturally and it's done. And people will learn a lesson from it. I think there was going to be more regulation on CeFi because CeFi is effectively banking, but shadow banking.
Sure.
And it's very different because it was made by human decision as opposed to algorithm, where everything that was DeFi was fine. Everything that was CeFi got nuked because there was human decision making in the process, and they were making irresponsible decisions with people's capital. And look, again, it's nothing new. Nothing. I wouldn't say it's even nefarious. Humans just do this. They've done it forever. The history of every financial book that's on my bookshelf is the history of exactly this
Yep.
playing out over and over and over again.
Yeah, and it's irrespective of industry too. Financial service. I mean, you could read about, culture creep in any organization, right? About from healthcare to automakers, and they talk about why all these companies kind of slowly crumble, and it's bad culture creep, which is very similar to
I mean,
underwriting standards.
interesting enough, there's a couple of firms who are everybody's biggest clients in all of the financial industry. And I've just been observing it because one day that too shall happen. Is the big private equity firms, Apollo and Blackstone and a few at Carlyle.
Mhm.
These guys are every investment bank's biggest customer. And they all use leverage. Now that look, these are smart people with diversified portfolios and everything else, but it just makes me think there's a weakness there somewhere. Because when somebody's your biggest customer always and they're the smartest guys in the room, there's a risk we're not looking at. And again, whether this is this cycle or the next cycle or another cycle, who the hell knows?
Mhm. Yeah, that really, I guess, just all comes down to time, and unless I mean, because there's ultimately it's the difference between forced selling, right? Because if they could stick around, like the return, the IRR might be horrendous, but you might not get wiped out. They
That's
might
right.
not.
And they're probably too big to fail. So maybe
Mhm.
they are backstopped anyway. So it doesn't really matter. Because don't forget, they own all the real estate portfolios,
Yep.
half the bloody private firms in the United States, well, globally. So maybe they're too big to fail. So maybe I'm stupid. Maybe they're just a part of the Fed now. So it doesn't really matter.
No, I mean, honestly, I've never heard anyone say that before. So it was tough to me to really internalize that and then articulate anything like mildly coherent
No,
that
but yeah,
quickly.
even talking through it with you, I've realised actually it's nonsense because they're just an extension of the Fed now. Because
Yeah.
there's no way they can go bust.
Well, yeah, I mean, if AIG and Hartford and got TARP money just because they were their books were totally mismanaged, they're like levered on CDO squared. It's like, yeah, they're probably going to bail out, Apollo too, if they need to. And I'm certainly not implying that they do.
No.
Um, Interesting. So, right now, what I see in the hedge fund world in crypto is ton of stablecoin, outstanding, right? So a lot of money on the sidelines, not out of the system, but just not allocated. Um, there is no one bullish, right? You feel, um, it's very easy to sound smart when you're bearish, right? Like that's the easiest thing in the world, but like they're never right long term, because they're never no one's right long term. Now when you have this kind of like monetary and interest rate environment over an extended period of time. Um, but I think the one thing that a lot of people struggle with is like, well, okay, even if you agree that we've bottomed or are bottoming or in the process, I think the consensus is that we kind of drift here, right? Like, what is the catalyst to get us higher? And it sounds like to you the catalyst is, we're at we're in a recession now, whether it's official or not, and rates are getting cut again in the next 6 months. I don't want to put words in your mouth, but that's like basically what it sounds like you're saying.
Yeah. And listen, what I know from markets is particularly at these points, you look for the path of pain.
Mhm.
You can see it in the NASDAQ, you can see it in crypto. The path of pain is up. Why? Because everybody's underweight. Everybody. Retail, hedge funds, family offices, institutions, everybody. So everybody's short the upside. So ETH merge, everyone starts buying calls. Why are they buying calls? Because they're still scared that the market could go down, but they can't be caught out if it goes up. So they're doing, and that tells me a lot, right? It's not like they're record positioned already and they're adding calls for extra leverage. They're doing it because they're terrified of getting back in. So they're buying calls. So we can see this structure going on in the NASDAQ as well. I mean, people like Kotu, 70% cash.
Is
Well,
that right?
that's a big problem, because if the Nasdaq keeps doing this, they're massively underperforming, and their job is to be technology investors, not cash managers. So you can do it for periods of time, but if you do it for long, you um, you're going to struggle. So what happens? So I can see the debate. So the debate is, well, you weren't around in 2018. I've been around since 2013. You weren't around in 2018. 2018, well, goes sideways. Okay, so that's the narrative. I'm like, yeah, but we didn't have this macro backdrop. So I think that's different. Also, we didn't have the amount of institutions and others still coming into the space. It's endless, still happening. So I'm like, so there's demand. And then we've got the ETH merge, and everybody's underweight. And everyone's looking at this resistance in ETH between 1800 and 2000. And everyone's going, well, it's never going to clear that. It's going to go straight back down to the new low. That's possible. I'm not saying it's impossible and that I'm definitely right. But I just think, what if it doesn't stop here? It's just had a pullback. Okay,
Yes.
so ETH has been pulling back from touching those levels, which were the lows in 2021, stuff like that. What happens if this little pullback is just the pause that refreshes and we go blasting through 2000? Okay, now we've got a blind panic, and the people who have to panic first are the hedge funds.
Mhm.
Then, once that starts happening, it's the retail, because the merge narrative will now become a retail narrative. It's going up for the merge. You've got to be involved in the merge. And then you probably have a pullback somewhere around that's pretty sharp and nasty because everyone's kind of got in.
Mhm.
But the institution's going to look at this and go, Christ, we've got a yielding asset, a yielding technology asset that is uncorrelated over longer periods of time to everything else. And we've been doing the work on it for the last 2 years. I think there is obviously, the market could go down to new lows, the market could trade sideways, the market could grind higher, or the market could V-shape. For me, the highest probability is the V-shape. And I know that sounds like hopium, but I'm doing it by looking at every participant and their pain points. Now, could be wrong, but only one of those is a new low. So why do I care? Secondly, we're at everybody's got their own favorite analysis for this, whether you're using the weekly RSI or whether you're using the 60-month exponential moving average or whether you're using the logarithmic channel. Right, we're record oversold. We're right at the levels. Whether we go down 50% from here or we don't, the upside is 10 to 20x on the entire market cap. This is like the best opportunity you're ever going to be given. And people are thinking over the price. Was it going to go to a new low? I'm like, you're crazy, guys. This is the opportunity. This is the opportunity you're all waiting for, but you can't see it because you're all tick-watching charts and listening to each other get bearish on Twitter. It's like, zoom out, find me a better risk reward. Sure, you might be able to nail and get it down to exactly the tick, But for those people who are longer-term players, here's the risk reward just laid on the table for you, and people don't want to take it until they're forced to take it because the price is going up. Because everybody was sitting there going, well, Bitcoin's going down to 15,000. Bitcoin's going down to 10,000. ETH's definitely going down to 500. It's like, really? You're all sitting and waiting for it. You're all underweight. Who's the seller?
Yeah, a lot there also. I'm surprised to an extent to hear of those different scenarios that you think a V-shape is the most likely.
Because
I hope
nobody else.
that's right.
Because
No,
nobody else.
I haven't heard it. I haven't heard it. The only thing I would probably push back on you is the kind of institutional narrative. There's a lot of and there's a lot of announcements, especially when you get to the banks, and I mean, there was one, today, right? With Coinbase and was it Blackstone?
Yeah.
But I talk to a lot of these guys. It's a lot of like running on a treadmill. They do a lot. They hire people. They move people around. They don't actually do anything. And I think what we need to see is
Yeah,
we
okay.
need to see regulation,
So
in the space.
no, they're all they all will do it, and they will all do some of it. We know that. So the question is why haven't they pulled the trigger? Well, the price has been falling. These people are generally price takers, not price makers. So you are now going to a situation where, let's say, ETH is at 3,000.
Hmm.
It's going up. Maybe the Nasdaq's going up. People starting to see the bond yields are down at kind of 1.5%, and ETH is yielding 6%, 8%, whatever it's going to start with. This ETH merge is a very, very big deal because of it creates a benchmark yield for the entire Web3 space. This is like everything else can be priced off it. So it can be ETH plus 400 basis points, which is how the world works
Hmm.
in traditional markets. I think everything should get priced off ETH. So
So you
it'll
mean
be,
prime rate?
yeah, so ETH is benchmark, ETH is treasuries. So 1 year ETH is the benchmark rate for Web3. Now we can understand what all risk is and we can trade spreads. So we can now trade risk more efficiently. Part of the issues we've seen is you didn't know what risks was what. Now we can do that. So institutions love yield. They don't like Bitcoin. They don't like Bitcoin because the ESG narrative,
Hmm.
and they don't like Bitcoin because it doesn't yield anything. So now you've got a cryptocurrency that is basically access to a technology of gigantic proportions that pays a yield and has negative supply. So this is basically Google giving you 8% yields and buying back their shares. Right, that's like the holy grail. Network
Look,
effects plus coupons and
I
reduced supply. I mean, so I think they will come. They will come in for this because and they only have to come at the margin. They don't have to come with their first 50 million bucks. How
Oh,
does it
I mean,
work?
yeah, I mean, any like the capital in the space now is such a drop in the bucket to the eventual, um, the eventual investment allocation, issuance, call it what you want. I just think in order to see anything really large, we're going to need to see a some sort of defined slash regulated custodial environment and then frankly whether it's like prime brokerage or issuance, there needs to be regulated exchanges as well. And like I actually think the most recent uh, bipartisan bill from, I think that was, gosh, yesterday, where you're really looking to overtly define what an asset is, right? Is this a commodity? Is this a security? Who is the regulator of choice? I think it's smart putting more under the guides of the CFTC, mainly because I'm a much bigger fan of their chair, but personally, but that is I think what you'll need to see the large banks get involved in a like underwriting component, not necessarily an investment component, but certainly an underwriting component. And that's what I think you'll need to see all these large, corporations with equity, publicly traded corporations to truly issue tokens on their cap table, right? Whether it's, Starbucks tokenizing the rewards program, whether it's airline miles, whether it's
Yeah,
loyalty
and
points.
that's just a function of market cap, time, and regulation. So
Mhm.
it's the rate of change is what I care about. We kind of know the end story, right?
Yep,
Which is why this is so attractive as an
totally.
opportunity. You kind of know where this is going. So, what is the rate of change and when does it occur? Because that's when we make all the money. Once everybody's in, we don't make all the money. It's everybody coming in that makes the money. And so it's
Absolutely.
the incremental new dollar that flows in that wasn't in the system before that's really interesting to me. And so what you're describing is now a path to exponentiality.
Hmm.
And so the best place to start that path is at the low end of the range when everything's oversold, knowing that we're going to be starting the next bull market with $1 trillion market cap. Okay, that's kind of interesting, because once you're up at $10 trillion, which is somewhere the magnitude of where we'll be at the next peak of a cycle before the Fed start reducing liquidity again, well, at $10 trillion, you've pretty much sucked in the sovereign wealth funds too. And again, with their first allocation, because the larger the market cap, the less they're able to ignore it. The next
Absolutely.
cycle up, the first wave of innovators, well, we're seeing it already. We're seeing it with the fashion brands. We're seeing it with music industry. We're seeing it with a bunch of stuff. And people like Starbucks and a few Adidas and stuff like that. But once they've gone through another cycle and people realize this is not going away, then it's like, boom, we're at the 4 billion users worldwide, because we'll have central bank digital currencies as well. So I just think of it as a path, and we're all a little bit too used to looking at it on the log charts, and it all looks quite smooth now.
Hmm.
But you've got to look at each one of these moments on a bloody linear chart sometimes to remind yourself what
Oh,
exponential
100%.
means.
Yeah, 100%. I mean, I remember like trying to zoom in and look at Amazon charts from, from October 2001 in different time frames, zooming in and out to to see what it looks like. If you look at it in 2002, you're like, shit, I missed it. Amazon's up 4x. It's at $4 now. Can't buy this. you know?
I mean, I've used that Amazon chart a lot and I've broken it down. It's actually very similar, and you can see network adoption because these swings get less and less and less over time, and then it just goes higher, and the pullbacks are like 15%, and that's it. But it still keeps going, and it's truly exponential. Uh, so yeah, everyone's like, well, when are the institutions coming? I'm like, they come like the tide coming in.
There's a
And
bigger
then
FOMO.
occasionally
Yeah.
you get a big wave.
Yep. That's exactly right. Because there's a bigger herd mentality especially in the allocator market, but I would say in all the institutional market, there's a bigger herd mentality than there is in even retail FOMO, right? Because no one wants to be first, but you sure as hell don't want to be last, right? So
And
that's
and the
every
big
pension fund, everybody.
and the big wave, I think, in the terms that we think of in terms of financial market access is, I think you're also right. I think a lot of people would not put Bitcoin and ETH on their balance sheet, figure out custody, all of that. They all did VC. They've done that.
Mhm.
VC is now expensive. It's illiquid for a period of time, but they got them their toes in the water. The next thing is going to happen is the hedge fund space. And what's super interesting to me, there's $4 billion in the digital asset hedge fund industry. It accounts for a small fraction of the market cap. And that means that the secondary market liquidity is minuscule,
Mhm.
because players like 3AC, frankly, nobody's, were the biggest lending provider. So
Mhm.
you're like, huh. So there is no secondary market liquidity. $4 billion versus a $3 trillion hedge fund industry. So the next obvious place for pension funds to allocate, and reinsurance companies and insurance companies, all the guys who want to allocate capital to longer term themes, is the hedge fund industry. Because no custody, not daily mark to market,
Mhm.
and it's a product they know. And that's why I started a fund of funds, is for that exact process, because it's even difficult for them to choose individual funds, because they don't even know how to ask the due diligence, who's your custody with and all. So it's like,
100%. Yep.
so that I think is the next wave of bringing capital in, because it is so capital starved that we probably had in the entire space last year, fresh capital into hedge funds, 500 million, 700 million.
Hmm.
Not, it's minuscule.
And
Even if it was
not many players. Like we were probably half that, if that's the number. Yeah, that's
yeah,
wild.
that's right. I mean, whatever the number is, even if it's $1 billion,
Yeah.
right? It's a 60th of what went into VC in the same space.
Oh, 100%. 100%.
And I've seen this play out many times before.
Mm-hmm.
First it was
Happened in Web
VC in the
1.
90s. First it
Yeah.
was VC in the 90s. That was the launch of Sequoia and all of these guys.
Yep.
And then the tech hedge funds, Dawson Sandberg and all these sites became massive.
Mm-hmm.
And then the tech, long only funds and and it became huge.
It happened
And
twice in tech. You had Web 1 and yeah, Sequoia, but then Andreessen Horowitz launched in 08, 09?
yeah, but I'm thinking about, but we didn't see the rise. Yes, we saw the next rise of hedge funds like Kotu were on the
Yeah.
back of that, right?
Tiger Global, yeah.
Tiger Global. Well, previously it was a whole bunch of other funds back in the day. So those are the waves. They start with VC,
Mm-hmm.
they get investor approval, they get comfortable, then they come in via the hedge funds, and then they come in everywhere.
Yeah. Yeah. No, I think that was my thesis going into the year, which proved completely wrong, at least in the very near term. I think, and there's been a lot of people delay because I mean, we talk to the allocators, and I do personally every day, and allocations that were planned for 1Q, 2Q are now 4Q. And
Yeah,
that's
because
just
they're sheep, right? So the
yeah,
opportunity that you've been telling them exists occasionally in crypto markets, which is called crypto winter, when you should be putting your money to work, they're like, well, I just want to see how it trades for a bit now. Like, really, guys? This is what we told you to do.
yeah.
Here's the chart. This is how it works. Yeah, we'll just wait a bit because they're also being beaten up on other parts of their portfolio.
Yep, that's right. And there's every entity has its own bureaucracies, whether it's board of trustees or investment committee, and the asset class is still so like just misunderstood, and there aren't besides honestly like besides Real Vision, and this is not me just plugging it's the truth. There are no good educational resources. You go onto Twitter, it's the biggest turnoff in the world. Like the I the more I experience like Bitcoin content on Twitter, the more I hate Bitcoin. And I like Bitcoin. I own it, but like I just
Yeah,
can't.
I, I can't.
It's so repulsive to me, like the pretentiousness.
Yeah, I agree. I agree. I think um, there's a few of the media outlets have done a good job. I think Bankless do a good job, Defiant
Mhm.
do a good job, but there's very few and far between. And the rest of them, are talking to retail, but everyone's talking to different parts, of the market.
Yeah. And if something doesn't work, it's a scam. It's like sometimes things just don't work. It doesn't.
It's like, really grow up. But
It's unbelievable.
most of that comes from the Bitcoin people because they want
Oh,
everything else to
100%.
fail. They want the world to burn. So the gold guys are exactly the same.
Hmm.
Everything is a scam. Technology is a scam. Technology investors is a scam. Cryptocurrency is a scam. Climate change is a scam. EVs are a scam. Everything is a scam to a gold person,
Yep.
unless it's gold, because that's the one true God,
Hmm.
which has gone down 28% in real
Yep.
terms in the inflation, and didn't offset the central bank balance sheet expansion either. So it didn't work for debasement and it didn't work for inflation.
Yeah.
You're like, really? And you're still going to worship this one?
Well, the argument of like a Bitcoin as a store of value, proved not true. I'm like, well, neither did gold, so I guess it is kind of the digital gold, right? They both did the exact same thing in an inflationary environment. And then, yeah, but I was sitting at a baseball game the other day with like peers in different industries, and one of them was talking about just not the quote unquote like not getting crypto because the government will just do it. I'm like, well, okay, well, like, what do you mean by that? And he was like, yeah, he's like, I don't know, the government will do it. I'm like, well, that doesn't mean anything. It's like the government will do like a CBDC that would actually be positive. Like it would get everyone, on a wallet. Like everyone would have a MetaMask. Like you now, you have more buyers, you have more
No, but
sellers,
they'll
right?
issue their own cryptocurrency.
He's like, they'll make
Okay,
their own
what do you mean
Bitcoin.
by what do you mean by cryptocurrency?
Yeah.
Yeah, it's like, well, I don't know, but this this stupid that you think yeah, it's like because a lot of people just see the world that they know, turn around and see the world that they knew, which is
Hmm.
why everybody thinks the 1970s is back because that's what they knew,
Yep.
and they can't imagine there are different probabilistic outcomes because they don't know. And people have this tremendous recency bias.
Yeah, no,
So,
absolutely.
which is why the crypto space says, well, it's going to trade sideways. Yeah,
Well, and that's what they know. This is a group where, if you're older than 27, you're a boomer, I guess, or something. I don't know what the exact age is, but it's like no one's experienced anything. It's like you weren't, here in 2018. Give me a break. Like I've been around. It's just markets are markets, and they each have their own, kind of in point of time unique qualities to them. But at the end of the day, it's all driven by human psychology.
yeah, exactly. I'm just looking at the Bitcoin chart while I'm looking distracted. I'm just looking at it. I don't think that rounded bottoms are what Bitcoin does. If I'm looking at it, yeah, 2020 was the sideways move, right? That was the, oh my
Mhm.
God. Just looking at my Bloomberg here. It's actually, okay, fair enough. 2015 was sideways. Uh,
2015.
2015, so 14 was the low. 15 went sideways for most of the year and then took off. 2011 was basically vertical from the bottom, sideways up. So that was an up only market. 2013 was an up only market. So, right, 50-50. Two sideways bottoms, two V shapes.
Yeah, and we look at that and say, okay, well, like who the hell was in the market in 2013? It's like it's irrelevant to today. But in 5 years, people are going to be like, who knows? We might be saying, well, this is the way it was in 2022, and they'll be like, 2022, the market was tiny. No one invested in it. So it's just, I don't know. There's a lot of recency bias. I think that's exactly right. I think that's exactly right.
Yeah,
So,
because it's all about, listen, Sonny, I've been around since 2018. No, I've been around since 17, and we all wore that 85% sell-off, and it took ages before the market recovered. You guys have no idea. It's
yeah,
like,
they're like
okay, we
they
got
act like World War II vets.
four
Yeah.
bottoms of the Bitcoin cycle, and now you're going to judge four data points and assume that you could do everything. All you need to do is look at other stuff, as you said, Amazon, stuff like that, and you can see
Yeah.
some sideways, some just go up sharply and then trade sideways for a year and a half
Mhm.
in the middle of the trend. There's all different ways that we can skin this cat. It doesn't have to be what happened last time.
You look at the mark indicators on Bitcoin and ETH.
Uh, I like a crack addict, but
Yeah.
other than that, no.
I figured you did, but yeah, I mentioned that to some people, and
That nailed the low. I bought exactly when that, so I as aggressively as I could, both in Ethereum and Solana, and I thought that's the low of this cycle, and it nailed it. I
yeah, I
was using
figured.
the weekly, and the daily, and it all lined up, and that was it.
Yep. Yeah, yeah, because yeah, I remember you mentioned that resistance level. I think it's like 1830 or so is a weekly weekly resistance level there, and yeah, if we shoot through that, or yeah, it's the one thing. I mean, I'm not a technicals guy, but like I've been following DeMark for a while now, and it's just uncanny how well. It's a reason why it's
I
expensive.
discovered him. I discovered Tom's work in 2000,
Mhm.
and I was looking at a mate of mine at GLG. He was like, "What the hell's this?" I've always been a technicals guy. What the hell's this stupid numbers thing? He goes, "It's incredible," and it just come on Bloomberg, and so I started using it. I became addicted to it. I've used it ever
Mhm.
since, and I've even persuaded Tom DMark has we've created an entire course as part of the whole Real Vision Academy.
Is that right?
Not out
I
yet,
gotta.
but it's coming out.
Oh,
Tom has never done anything like this before. He's a very private guy because he's like Stevie
oh, I
Cohen's right
know.
hand man, John
Yep,
Burbank's right hand man.
yep.
Right? Tom is the man, and I persuaded him to do it. And actually, to be fair, John Burbank did. So it's incredible.
Yeah, absolutely. Well, what did I not ask, or did we not talk about that you think is important?
The one thing that I think, just moving forward into the future, that people should keep an eye on is everything you think you know about NFTs is nothing.
I like that.
NFTs are basically a unique contract. People use these terms without understanding what that means.
That's exactly right.
An NFT is an unlock for everything from plane tickets to hotel rooms, from concert tickets to insurance policies,
Memberships, everything. Yeah.
everything. And people just still are hooked on what they saw at first, which is artwork and communities.
PFPs, yeah. No, I that is it's actually I'm glad you brought that up because it was one of the things I was thinking about when we were talking earlier about kind of just like the general misunderstandings of the market. Because I'll talk to people. I'm like, yeah, we have a pretty good size NFT fund, and and like I'll get anything from like a surprised look to a because like people know me personally, not professionally, like are surprised when I say we have a large NFT fund. But it's like, well, all an NFT is a certificate of ownership just on the blockchain, right? Could be anything. It could be physical good, it can be cash flow, it could be mineral rights, it could be anything. It doesn't have to be a picture of a donkey or whatever it is, but it can be, I guess.
It can be whatever you want it to be. And what it does is creates digital scarcity that we talked
Mhm,
about earlier on in a digital world where everything goes to zero, authenticity or verified authenticity, and transferability.
mhm.
These are huge things. Just imagine all the hotel rooms and flight tickets that you've lost money on because you couldn't go at the last minute, something happened, whatever happened. Once they are NFTs, you'll just be able to sell it.
Absolutely.
Because both the hotel right now and you, or the airline and you, lose money when that happens.
Mhm.
They don't want it, but you 24 hours notice they can't fill the hotel room, so they miss the extra revenue of you going and having a beer in the bar and grabbing dinner or whatever. So if you have a marketplace to clear hotel rooms, well, I'm coming into New York, I see your hotel room for sale, I just buy that, I get a bit of a discount, you get most of your money back, the hotel gets a share of the
Transaction
revs.
fee. Yeah.
Everybody's happy,
Yeah.
right? That's the efficient use of capital you're referring to before. Lost capital in the system, you free it up. So now you would have been $500 down on your hotel room. You're now $350. You're now $150 down. The hotel would have lost the extra food and beverage stuff. They've now got the new person coming in plus the commission, so they're good to go. And the new person has bought it at a discount. They're good to go.
Mhm.
Everybody's a winner.
100%. I could not agree with you more. I think it is the most misunderstood. I don't want to call it an asset class because I don't think it's an asset class.
Technology,
Technology, yeah, it's the most misunderstood technology in existence right now
because
because
we're
it
anchoring on
will.
what we know.
Yep,
It's like
exactly.
the Bitcoin community still anchor on currency,
Hmm.
right? And they're
Yeah,
like ETH, it's not the same. It's not. It's like
it's not
it's
hard
not.
money. It's like
Nobody cares.
yeah.
It's because they anchor on what they came in to the space on.
Hmm.
So I think the NFT crowd is slightly more open-minded, but people just don't know what they don't know yet. All I
Yeah,
know is it's much bigger than any of us know.
yeah, and like any other kind of like new technology, there's a lot of you got to be careful. There's a lot of scams, a lot of people trying to take advantage of other people, and maybe I don't know, no more or less than anything else. It's just probably faster, easier to report. Everything's
Well,
transparent, so you know when it
well,
happens.
let's put it a different way. How many pieces of art have you bought in some stupid store, whether you're on holiday or whatever, right? And you go in, it's like priced at $500. It's like, oh, this is amazing. You're in Morocco on holiday, you buy something, it's $500, you take it home. It's worth zero.
Oh, sure, but
You
that's the
know,
asset. Yeah, that's the
sorry?
asset. That's the asset. I'm talking about just outright. You
Well, is
know,
that not
the
an outright
Discord.
scam? The guy is selling you, oh, no, this is a great piece of art from Morocco. Most of the art we all buy is worth zero. So if you're going and buying a donkey PFP that somebody's selling at $500, 0.25 ETH, and it's actually worth zero, that's exactly the same as how all this other.
Oh, for sure, for sure. No, no, and there are crap projects out there, but there are also, the Discord to whatever gets hacked, someone puts up a
Oh yeah,
fake
yeah. I mean,
link and you get your MetaMask drained.
it's the Wild West.
Yeah, yeah, yeah. Which also speaks to, like, and this is another thing with the Bitcoin crowd is like they don't want regulation, everything we don't need it, it's like, no, yeah, you want this to grow. You actually do. You actually
But
do
you know
need it.
what? What's funny is we've got an internal Slack channel at Real Vision called like Filthy Degens, and it's a bunch of NFT degens
Yeah,
in that channel. And these are magic days. These
yeah,
are magic days that we will all look back with fondness. The craziness of the NFT space, the allow list, the bots, the scams, the projects that become Bored Ape, the all of this is what it's like to be somewhere early.
yeah.
The days that you look back on with fondness, because people in the NFT market don't even sleep. I don't even know how they keep on top of all of this stuff. But these are magic days because in
Mhm.
the end it'll become a regulated, it'll become, very different than it is now. I just
That's
think
totally fair. Yeah,
it's like the first days of a startup are always fun because it's all promise. You don't quite know what you're doing, and then it becomes
it's
bone
horrible.
crunching
It's
misery
horrible.
for ages, right? And but anyway, these are magic times when people have got a grin on their faces, even when they get rug pulled, lose money. It's a game of snakes and ladders everyone's playing. You're
Yeah,
trying to get
yeah.
up, and then you get down, and then you get up, and you get
And you
down, and
keep coming back.
you come back. Yeah, it's because it's hilarious. It's
Yeah,
hilarious to watch.
yeah, yeah, yeah. Well, it is the future. I mean, I'm 100% convinced of that. You know, here I am, right? So there's other things I could be doing. But look, this was a great conversation. I loved it. Really enjoyed it. I couldn't think of a better person to have on um, for the relaunch. So I know we're up on our hour here. I'll let you run, but Raoul, as always, great speaking to you, and hopefully we'll talk again soon.
Yeah, lots of fun as ever, my friend. Good to see you.
Absolutely. All right, take care.
Yes.